In this video, we're going to discuss, again, average returns and why they are misleading, or why it as a metric, as a measure, is misleading for investments. Let's start with a story. Imagine you're 22 years old, walking into your first employer HR department, human resources, and the rep sits you down and says, okay, here's a clipboard. We'd like you to sign wherever there's one of these tabs. And, well, we're going to sign you up for the 401k program, unless, of course, you don't want to sign up, but we think it's a good idea. What you'll be able to do is put money away pre-tax. And, well, how old are you now? 22. And when will you retire? What do you think? Well, let's use 65. It seems the common age for retirement. People talk about 65. So let's see. 65 minus your 22 now, so that's 43 years. You'll be able to save for 43 years. And you know the stock market's returned an average of 7.3% over the last 10 years. That's pretty good, right? So 7.3%. And if we look forward, well, wait, let's go through this. 7.3, well, let's be conservative. We'll use 6.3. You've got 43 years between age 65 and age 22. And you know we get paid twice a month. And how much will you be able to put away? Well, it says here, well, if you can put away $212.43 per paycheck, twice a month, 43 years, 6.3, conservative, instead of 7.3, you will have $1.33 million at age 65. How does that sound? Pretty good, right? What I've just laid out there is fiction. Not because what you'd expect. Maybe they change jobs, maybe there'll be fees attached, all these different things. But the number one item, and certainly what we're focusing on today, is the average return used for historical performance of the stock market, and therefore the prediction we would use, or projection, straight line projection for retirement savings. So I'll explain further. What is an average return? Well, according to Investopedia, the average return is very simply a calculation of individual returns for the years we're collecting here. Let's say 10 years, 20 years, 30 years, whatever. We get those individual numbers, get the total, and then divide by the number of years. Just like we did bushels of corn in sixth grade when we were taught how to calculate an average. The problem there is that those numbers used for average returns have to be connected when we're talking about a dollar result. Why? Because we have what are called pivot points. A pivot point. If I start with $100 in my investment, and it goes up 100%, I've got a 100% gain. If the next year, the second year, that 100% gain goes down 50%, what is my average? Well, up 100%, down 50%, for a net of 50. It's a total, right? Plus 100 minus 50. I take my 50 net, divide by 2 for 2 years, I have a 25% average return. Also, let's imagine I have an investment that goes up 60% in the first year, and then down 50% in the second year. Up 60, down 50, get the total is a net of 10. Divide the 10 by 2 years, I have a 5% average return. Here's the problem. I take that series of moves, try it with $100 as my starting point. In the first example, my $100 goes up 100%, I have $200. My $200 goes down 50% in the second year, I have $100, right? $200 goes down half, $100. Where's my 25% average return that we calculated a moment ago? Doesn't exist, because my $100 went up 100%, pivot point from here to here, $200. My $200 goes down from here, pivot point, to here, $100. Isolated numbers gives me a different result. percentage changes are what we're actually talking about there. If I use actual numbers, actual dollars, actual investment, I need to know where I'm going and what the direction is and whether I have a loss, a profit, and so on. Second example I gave you, $100 goes up 60%, then down 50%. My $100 up 60% is $160. My $160 goes down 50%. Now, a moment ago, we calculated that's a 5% average return. Up 60, down 50, net of 10 divided by 2. But $100 up 60% is 160. 160 down 50% is 80. Not a 5% average return, an actual return where I've lost money. Let's take that and turn to this on the screen. Here we have a series of 8% returns every year for 10 years. So, plus 8%, 8%, 8%, 8%, and so on, out to 10 years, I get an average. How do I get the average? I take each year's return, percentage change, but each year's number, get the total, in this case it's 80, divide by 10 for 10 years, I have an 8% average return. Easy. And in the case where I have a consistent growth rate, straight line, I can assume that's correct, and I can lean on that as accurate. However, here's a second panel to take a look at. Here I've exaggerated, admittedly, my volatility. What's volatility? It's changes. Up, down, up, down, up, down, 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 down. Whatever the changes are, that's referred to as volatility. It's volatile. It's movable. It's not a straight line. It is up and down all over the place. So in the example I'm showing you on the screen right now, I go up 56% in the first year, down 40% in the second year, up 56%, down 40%. I continue that for 10 years. 5640, 5640, 5640, and so on. I get the total at the end of the 10 years. Again, I have 80. I divide my 80 by 10 for 10 years. I have an 8% average return. Now, here's the difference. In my first example, where I had a straight line move 8% every year, my $100 that I would invest at the end of 10 years is almost $216. Why? Because my growth is 8% on top of 8% on top of 8% on top of 8%. It's compounding, growth on growth, interest on interest. When I have volatility, on the other hand, up 56%, down 40%, $100 invested in the first year becomes $156. My $156 in the second year goes down 40%. 40% of 156. I have a bigger drop than I have climb in actual dollars. That's important. And my volatility continues in this example I'm showing you. When I have drops, or even zeros for that matter, I have what's referred to as a need for a recovery period. In other words, if I go up, but then I drop, how do I get back to where I'm supposed to be to continue my climb? I have to recover from that drop. Recovery period. Pretty straightforward. When I have volatility, I have a series of needs. Irregular perhaps, but still more than one need for recovery. Whenever I have the need for a recovery, do I know how long the recovery will take ahead of time? Of course not. Do I know during that period? Of course not. Do I know after the fact? Yes, I can look back and say, oh, it took a month, it took a year, it took a week, whatever it did, but I can look back and figure it out. But when I have that recovery necessity, it gives me an irregular or a change in result. That's important. So when I did the 8%, 8%, 8% first straight line projection, I ended up with $216. $100 becomes $216. When I have admittedly exaggerated, but volatile nonetheless, series of ups and downs, I end up with an 8% average, but only $72 at the end of 10 years. Now, wait a minute. I start with $100. I have volatility. I have an 8% average, and I have a loss? How is that possible? Is it fees? Has nothing to do with fees. It's straight recovery, growth, recovery, growth, recovery, growth. Whatever the regular or irregular pattern is, I have a number that will differ from a straight line projection. Don't trust this, work it out. Put down a number of irregular patterns and see what you come up with. Calculate the average, get yourself a number in terms of what the results are. But this is important. Why? Because when in this HR example I gave you in the beginning, when you hear someone say, the average return on this investment was, or the average return in the market was, or the average return in X, Y, or Z was, rest assured, unless it's a perfect straight line, it's not accurate. And the more irregular, the more inaccurate it is. Now, what does that mean? It means that I can have an average that sounds spectacular, 8% for example, or 7.3 in my story. And I can assume that that compared to 6.8 or 8.2 gives me some frame of reference to determine a better investment, a better potential result in what I'm trying to accomplish, collect money, put money toward retirement or toward a down payment on a new house, whatever it is. But when I'm looking at, and I quote here, air quotes, average return was, nonsense. Walk away. It's not accurate unless it's a straight growth pattern. It has to be dead straight. So where does this take us? Why is this a big deal? Well, very much like the story, the HR story. If I believe that the average return gives me what I'm looking for, that is, the HR rep says, you'll have 1.33 million by the time you reach 65. If I believe that and I decide to put away $243.12, per my example, for 43 years, I'm thinking all along the way, I'm set. This is what I've got. The target will be accomplished. It will be reached. I'll be there. And then you find out along the way that the reality is not in line with the story you were told. What do? Therein lies the problem. And let's take this a step further. You may have heard, as I have many times, that the stock market has returned, well, actually more specifically, the S&P 500 has returned an average of 10.2% over the last 100 years. Now, you may have heard a slight variation, 100 years, 10%, or roughly 10% over 99 years, or something close to that. Here are the details. The details are, number one, when you hear the S&P 500, that's a slight exaggeration. It's not quite accurate. Why? Because the S&P 500 per se, 500, did not exist until 1957. If I'm looking back 100 years, I'm dealing with the first quarter of the 20th century. 1926 was when the S&P 90 came to be. 1926, the S&P 90. 1927, I had a year's worth of detail, of data, of numbers that I could use to look forward from there. From here, looking back. But the idea of the S&P, okay, we're going to stop being nitpicky. We're just going to lean on the S&P. The S&P 1926, data available 1927. From 1927 to today, this is the year 2025. I have 98 years I can pick apart. 98 years, if I assume that number 10% or 10.2%, here's the deal. When you hear the average return was 10%, remember my story with HR. Remember the idea of if I'm not looking at a straight line projection, a straight line result, I'm not accurate. Well, with that in mind, here's the detail. The S&P 90, but the S&P, in 1927 year end was 17.66 according to my research on the web. 17.66. If I believe what I've heard about the S&P returned an average of, we're working on two levels now. On one level is what I'm hearing that I could at any point in time, if I were available in those years, I could just put my money to work in 1943, in 1982, in 2004. Any year I picked. Can I put my money to work and assume I will get 10% that year? Of course not. We know volatility is very real. But if I put money to work anywhere along the way, and I assumed that over time I would get 10%, is that realistic? You might think so. Let me help you here. No. Why? Because again, volatility. I don't know when the markets will go up. I don't know when the investment in particular will go down, up, down, or sideways. I don't know. So what's the validity? What's the point in saying the 10% average over time? Well, to be a little bit helpful in the mindset here, here's what happens. Just like the HR story, people come to this idea that the market always returns an average of 10% over time. So if I'm 22 years old and I put my money to work, over 50 years I should be able to pick up a 10% growth rate. Or somewhere along the way, 10% is going to help me here. 10% means something. It doesn't. Just like the HR story. 10% average is simply a measure of, and a very poor one, the average percentage change in any individual year over the course of the last 98 years. Let me say it again a different way. If I'm putting together all of those 98 years worth of changes, call it a return if you wish, but it's a year's change. In this case, the index being the S&P. Maybe it's 12.1% in a given year. Maybe it's down 4% in another. Maybe it's up 13% in another. I take those individual numbers, get them together, get the total, or sum if you wish, because there will be negatives. Divide by the number of years, it gives me an average. Is it meaningful for an investment? No, because it doesn't mean anything specifically. But here's where it does come into play. We can pick it apart. If you go back to what I mentioned in the year 1927, at the end of the year, the S&P average, the S&P number at year end was 17.66. 17.66. How did someone get to the S&P over 100 years or 98 years, average 10.2%? They looked at all of those numbers, or more accurately, they probably just went to some source, some historical source on the web, maybe the Federal Reserve information or some sort of a statistics company that would provide this sort of thing. They get those numbers and they give you the result. The average was. But here's the joke. If I take 17.66 98 years ago and I multiply that number by 1.1, meaning 17.66 times 110% of itself, I get 19 and change, 19.46, I think. But I get a number in excess of 19. If I do that calculation 98 times, 17.66 times 1.1, that result times 1.1, that result times 1.1, and that result times 1.1, 98 steps, 98 times. You would think that the S&P at today's level reflects that result. Here's the joke. 17.66 times 1.1 and again and again and again 98 times gives me an S&P index number of 201,000, not where it currently is, below 7,000. Let me repeat that. If I take 17.66 and I multiply it by 1.1 to show a 10% growth rate, and then I do that same thing again with the results every year, 98 times, I end up with a number in excess of 201,000. I encourage you to do the homework. Try it out. Now, what I'll show you on the screen, or what I am showing on the screen, is my handwritten results, all those years, from 1927 to today. I took the liberty of taking 2025 out to year end. Take a screenshot, page by page, there's only 3 or 4 pages. Check me on it. If there's any error, it may be a rounding error somewhere. But 200,000. So when someone says the S&P has returned an average of 10.2%, At one level, it's accurate because all you're doing is taking each year's individual result and getting an average. But in another sense, if you're using that to project forward, or using the HR story to go in and sign up for the 401k and project forward based on an average return, you're misguided. You're misdirected. It's not accurate. So, as a result of all of this, if you're using an investment advisor, or you're doing this on your own, you're planning your retirement, you're putting together savings, investing, whatever you're doing, and you're using the metric average return, you're not putting yourself into a good position. You're not helping yourself. There are other measures that are much more reasonable and accurate. So when someone says to you, the average return was, you should buy this, or this is better because the average return was 8 instead of 7.3, you should be saying, well, wait a minute. What was the actual return? Where did it start at? Where is it today? And show me the volatility in between. That would be a reasonable request. Typically not easy to answer, but a reasonable question. If you're going into investments and you're using the average return was, as your guide, you will probably end up disappointed. Be very careful. Average return is a meaningless or poorly used metric, and it is rampant as a metric in the financial world. If an investment advisor says the average return was, challenge. Now, following that challenge, here is, as it turns out, a use of that 10% average thing. What I'm about to read to you was an explanation as to what answer to give to a client, someone in the profession I'm in, advising in the financial world. What do you say to a client who says, the market seems scary, should I get out? And here's what's characterized as an insightful answer. Crash is a scary word. The stock market moves in cycles. It has returned about 10% annually on average over the past 100 years, outpacing other traditional asset classes. However, it does not move in a straight line. It goes up and it pulls back. That is why stock market investing is best for people with a long-term time horizon. Now, let's be realistic about what I just read. Has the stock market returned an average of 10% per year? Semantics are important here, and nuance. The stock market volatility, the change per year, the changes on average, has been roughly 10%, according to a number of sources. But has it returned 10% per year, outperforming other asset classes? Maybe, maybe not. When you're looking at this static measure, which we know is an illusion in most cases, and you're trying to determine if it outperformed, I don't know what, weak futures, the answer is, I don't know, but I'm becoming a little doubtful. Is it possible that average returns can be applied to wheat futures? Of course. The point is that this average return thing is misused constantly between professionals. In the world of finance, it is tough to find things that can be expressed easily so that clients understand the consumer, so that professionals understand. And the answer is average return is misused, very badly misused.